Hello, everyone. This is Donnie Satar, co-host of Value Seville podcast. Today's podcast is part 1 and 2 with Jeremy Deal, founder of JDP Capital Management. In this first part, Jeremy discusses an interesting investing analogy, gorillas versus monkeys, and the inspiration for this idea, which is an Indian investor that many might not know much about. I certainly didn't. So hopefully that's a value add for most of our listeners. So without further ado, Value Seville's first podcast with Jeremy Deal.
All right. Hello, everybody. Welcome to the Value Seville podcast, our first official episode. I'm Jeff Hendrickson, your host, here with my co-host, Donnie Satar, and our good friend, longtime Value Seville attendee, Jeremy Deal. Jeremy and I go back a long way, all the way back to ValueX Closters. I think 2017 when we first met, 2016.
Yeah.
Somewhere in there.
Around,
Jeremy,
then.
how you been, buddy? It's good to see you.
I'm good. Just enjoying the summer.
Yes, same here.
Getting
this weather.
As much sunshine as I can.
Absolutely, man. I'm doing the same. Well, look, thanks for taking the time to be here today. So the genesis of this podcast to bring Jeremy on was a presentation he gave at Value Seville this year, which I found very, very intriguing around, it dealt with a lot of kind of ideas, but at the core of it was this idea of investing in gorillas and not monkeys, which immediately when you hear that, you're like, wow, okay, exactly. What does that mean? And it dovetailed into this idea of a power law distribution, not only influencing the way that outcomes happen in life, but obviously the way that they happen in investing as well. And it got me really thinking about this subject in terms of how we, decide to weight our portfolios, how we decide to, how much to concentrate, things like that. And then you had mentioned a presentation that you saw given by a very famous Indian investor. I hope I'm saying his name correctly, Uptal Seth, and sent that presentation to me. And I watched it and I was like, wow, I understand why Jeremy's embracing this idea so much. Because the presentation that he gave, I think it was at the CFA, or was presented by the CFA Society of India, he really delves into this idea, and it deals with this idea of megatrends, finding a megatrend, which we can define what that is in a minute, but basically large trends that don't mean revert, that really change the way that we do business, the way we live our lives, et cetera. Finding these megatrends and then finding companies, leaders within that industry that are disproportionately getting market share from that megatrend, and that investing in these essentially ideas and concentrating in them is how you get gorillas in your portfolio. It blew me away, just how simple yet I think profound his thinking was. And something I do want to talk about, which is the Q&A at the end of that video, Jeremy, I found extremely interesting because it was at a traditional value investor conference, and the amount of pushback he got amazed me. And it's like, you have this super successful investor, and yet people were pushing back on this idea, which I thought was instructive in and of itself, in terms of kind of like in a traditional value community, how people might shun this because these gorillas typically are not trading at 5 times PE multiples. But anyway, tell us a little bit about, first of all, yourself, your philosophy, and then how this idea of gorilla investing is really influenced the way that you manage your portfolio.
Well, I met Utpal at a small conference in Switzerland, not ValueX, but a different conference, I believe in late 2023. And he gave this presentation on megatrends in leadership. And talked about, looking for gorillas versus monkeys, and gorillas are rare and in a jungle full of monkeys. And it just really resonated with me because it's a lot of how I definitely already kind of believe in this and invest like this. I run a concentrated fund. I'm looking for things that I can buy and hold for long periods of time. They don't all work out, but I like companies that I can buy, that I can be comfortable with owning for multiple years, that can continue to compound and have a high potential for outperforming the index over 5 and 10 plus year period of time. You don't have to trade. And so when I heard the presentation, it really resonated with me because this is how I had evolved as a manager, first starting with cheap small cap companies and then realizing, wow, this kind of mean reversion trading around valuations that are completely arbitrary just wasn't really right for me and my investors who are taxable, high net worth people in generally high tax states. And so, I made that switch, starting to look at higher quality companies I could potentially own for a long time, in 2015, 16, something like that. And it's just been an incredible learning experience. And so meeting Utpal, who's again a very famous Indian investor, he was the partner of the most famous Indian investor, who died recently, who just had an incredible return. I think he turned $500,000 into six plus billion by the time he died in 2022, I think, something like that. And the idea that he talked about, which again, just his words, and I encourage people to look him up find some YouTube videos, maybe put a link in the show notes here. But the idea is that in order if you are a buy and hold investor, it's very different from a mean reversion investor. So if you're the kind of investor that is looking for something that you could potentially buy and hold for a long period of time that could beat the index over a long period of time, there's certain things you need to have as a part of that. You need to have a long runway of growth, and you need that business to be able kind of getting better and better over time. And there's just not that many companies that fit that bill. And Utpal refers to these as gorillas. And he also talks about not only do you need gorillas and you need great companies, but you need a mega trend. And what he calls a mega trend are essentially just changes changes that are not mean reverting. So structural change versus mean reversion change or cyclical change. So cyclical change is okay, the price of XYZ commodity is down and been depressed, and we're going to buy this stock that mines this commodity. And then when the commodity goes up, we sell it, and we sell it for a profit, and then we go and look for the next thing. Or, this dog food company in middle America is trading for 5 times earnings because the market doesn't understand dog food, and you buy it, and then it reverts back to its historical multiple, and you sell it. So that's traditional kind of, I think, value investing. I mean, I'm not sure that's necessarily way all value investors think today. But what Utpal says is, if you're going to buy and hold, if you're going to look for the mega winners, you need a mega trend. So you need to be investing in great companies that are benefiting from major structural shifts that are not mean reverting. And so as an Indian investor, he was able to buy things and that were, I guess, what we would consider even probably more traditional businesses that were benefiting from major structural change happening in India as the country grew and evolved over the last, say, 20 years. But applying that framework to the West is kind of puts you in a little bit different, it takes you to a different category of businesses. So yeah, he's a fascinating character, and it tells an interesting story, and I think it's should be required reading for anybody really interested in value investing.
Yeah. Well, one thing I would just, I think it's worth calling out is the lifetime return of 500,000 to 6+ billion in a lifetime has got to be one of the all-time greats. We got to do the math on that and figure out exactly what the compounding was, but I think it's at least worth listening to someone who's gotten kind of those returns. Hopefully we can all can get those. So when you think about these mega trends, Jeremy, one of the, I was, when I listened to this podcast, and we've talked about this, I think, we in many ways and throughout the last, I guess, couple of years that we've known each other now. Do you think about them as ones that you're looking for? Or are you out thinking about these mega trends as an investor? Or are you thinking of investment ideas and then you're applying the mega trend later, right? Because it's kind of like a top-down versus bottoms-up approach in some sense. I guess I struggle with when I think of idea generation, is it coming from the concept of these mega trends, or is it finding bottoms up ideas and then letting the mega trend kind of
He addresses Utpal addresses this from what I remember, saying it's difficult to do this. It's very difficult. So this kind of investing sounds very easy, but in fact it's very difficult. And it's difficult because you have to think really broad based, but you also have to ultimately make very singular, focused, bottoms up kind of decisions where you're going to build conviction and have the ability to hold. So I think seeing the mega trend is relatively obvious, and it's something I think most people that are just in tune to what's happening around them can kind of see what's happening, structural shifts. Maybe some of them you're not interested in investing in, some of them you're more excited about than others. And I think from there, though, the real hard part is picking the companies that are going to be the outsized beneficiaries of that mega trend. Because as he also talks about, and we see it obviously in the West as well, because the leaders of those or the companies that are leading, or the gorillas, they ultimately take most of the gains and most of the growth and the economic returns of that megatrend. And it's because value migrates from everyone else to them, and it generally ends up concentrating in a handful of winners. And so all you have to do is look back at the greatest winners in the US market over the last 20 plus years, and you can see in all sectors, really, you can see a handful of great businesses, and you can also see the result of big megatrends, structural shifts, whether it's the iPhone, things like that, or just the commerce going online, big trends like that. You can kind of sit back and say, well, yeah, there's, a handful of businesses that really captured the bulk of those returns. And so it is part value investing meaning that you're buying a stock based on the future value, the current and future value of the business, so earnings power. So you're looking at earnings power of a business, but you also have to want to, bet on that mega trend and that shift happening. And there are plenty of them. So yeah, I think it's a difficult thing to do. The real money is made, obviously, buying these companies before the cat's out of the bag, so to speak, but after they've been de-risked. So they're no longer venture kind of investments. They're free cash flow positive. They don't require raising capital, but yet maybe the market doesn't fully appreciate or understand how big or impactful that megatrend is, or how long that megatrend will go on, or they don't understand the company's position in that. And maybe one of the most famous is Amazon, because even after they sort of invented the e-commerce market, people couldn't own the stock for a lot of investors couldn't own the stock, not just because of valuation, well, because they didn't believe that Amazon could maintain its market leadership. The idea back, even 15 years ago, well, if e-commerce really becomes prolific, then people would just do it. We don't need Amazon, and anybody can just sell something online. A lot of people didn't think through, how the company was evolving. So there's a lot of examples of this, and even non-tech and examples of this that we can explore. Anybody can explore, and it's just been a topic that I've always been interested in. Like, why is it that investors miss, especially people that call themselves buy and hold or value type of investors, meaning people that are supposed to be underwriting earnings power? How is it that they can't hold on, or why do they miss the benefit of these gorillas, as Utpal calls them, knowing that there's only a handful of them? And Buffett addressed this in 2023, I think 2022 or 2023 letter, when he said, out of the 58 years of being in business, only what did he say? 1 in 5 years did he do something that actually moved the needle for Berkshire. So it was a total of like 12 decisions out of potentially hundreds of decisions that he made over that 58 plus years at the time, moved the needle. So, putting that all together, it's sort of a natural. At least I have more of a natural gravitation to look for the businesses that they have the potential to be, or have the potential to continue growing and doing better than the average business over the next 10 or 15 plus years. A lot of that's going to be rooted in a mega trend.
And so the pushback that Utpal got, and that most people would give, is that, well, the valuations are too high, right? This is a value investor's first line of attack on an idea like this. And personally, I don't think it's a valid one, but our industry is filled with people that, rightly or wrongly, have studied, famous investors and have kind of fallen into this trap, I think, of wanting to not overpay, or if they are overpaying, they're paying, well, I'll reach up to 25 times, right? But like the idea that they're going to pay 50, 60 times. I mean, they're it's like they don't have it in them, and they worry about, well, it's going to be another .com disaster or another Nifty 50, and they look to history and they look at historic episodes where overvaluation led to pain, and they basically say this is another one of those. So they go back to this mean reversion mindset. And by the way, when they do this, they also think that they're smarter than everybody else. But what I would argue that they're missing, and I'd like to get your take on this, is that we're not in a mean reverting world when you have megatrends like this. I mean, by definition, right, as Utpal says, these are not mean reverting things. And when you couple a megatrend with a dominant market leadership position, I think the way he phrases it is that the impact that has on terminal value cannot be captured by traditional valuation metrics. And so you get, when these companies do well, you almost get people trying to mean revert the growth. It's like, I won't buy it because it's too expensive, or there are quantitative strategies that want to go long value, short growth. And so you do get some kind of incremental, I won't call it selling pressure, but maybe just not enough buying. And so these huge compounders just stay perpetually undervalued because the industry can't wrap their head around paying what ostensibly anyway seems like a high valuation. And so what are your thoughts on that? And I mean, personally, I'll tell you, I've made more mistakes paying attention to valuation, not buying something because it's too expensive. I've hurt myself more doing that than overpaying by a long shot.
Me too.
You know, I've missed out on so many big
yeah.
trends because I've been worried about a multiple, and
Yeah, I agree with
shame
that.
on
Yeah.
me. But
Look, we can all
any
be
thoughts
right.
on that?
I think that if you're buying a business that's at the end of its life or is very, very mature and you're going to take it private and the way you're planning to make money is just distribute out the cash, then you shouldn't pay more than whatever 5 times free cash flow or something like that. If you're going to wind it down, you're going to suck all the cash out and not reinvest, or it's just going to grow a small amount. I think that's totally right. If you're going to buy a stock portfolio, if you're going to invest in a stock portfolio and the investors are very sensitive to volatility and the market is high and we've been on a long run, yeah, it's going to, those companies with high multiples are going to contract and they're going to go down. And, that could be really bad for business. So, but I think what Utpal talked about, and you mentioned terminal value. He calls himself a terminal value investor, which I think is a really interesting twist on what Buffett calls what Buffett calls intrinsic value. So Buffett says he's an intrinsic value investor. And I think the terminal value investor is kind of the same idea. And these are kind of just concepts. They're not, it's not something you can put in a spreadsheet. I don't think somebody's saying, okay, this is the way the business is going to look in 10 or 20 or 30 years. You're just willing to hold the business as it evolves because you can see its leadership position and mega trend or a shift in society that is not going away. And another example of this that I like to talk about is Starbucks. It's a company I've studied a lot. I've never owned it because by the time I kind of came into Starbucks, it had reached a maturity level that it was no longer fit for my investing kind of what I do, I guess. But the Starbucks went public. Again, you have to fact check all this. Listeners have to fact check. This is just me off the cuff, but I believe it went public in 1992 at a $275 million valuation. And that valuation, in 1992, there's a lot of companies went public in 1992. I think it was over 400 companies in 1992. And you had some big, awesome businesses, considered just incredible businesses like some of them at the time, Gilead, you had the Buckle, you had, I believe, Lowe's or Kohl's. Some really big notable businesses went public in that year, but Starbucks in the end produced a 35,000% return, including dividends, and the market did, I think, about 2,500% including dividends, or even 2,300% including dividends. And the vast majority of those companies didn't do anything remotely close to Starbucks. I think the vast majority of those companies not only underperformed, but of the companies that continued to publicly trade. Now, some of them got taken out, some of them got bought or whatever. But if you had to go back in time to a value conference and say, hey, there's this company called Starbucks going public, and it's trading for, I think it was 80 or 90 times earnings. And on a current basis, on a forward basis, it was trading for roughly 30 times earnings and maybe high 20s multiple of operating earnings, which is the metric that Buffett likes to use. And you had to go back in time and give a presentation on, hey, I want to show you guys why this company is going to be worth, it's a multi-bagger. And you said, I'm coming from the future, and this company is going to be worth 30 times, or it's going to go up 35,000%, 350x, including dividends. Well, that presentation, the reason it would go up so much over that next 30 plus years is not because of price. And in a way, valuation over that time horizon is almost worthless. Because whether you paid 80 times earnings or whatever, if you waited until it dipped a little bit, I think it was 27 cents per share price adjusted for that time. Whether you paid 27 cents or 22 cents or even $1, I mean, it didn't matter. The point was that if you bought the right company and you were able to hold it, your returns were just so much more superior to the S&P 500 and to most businesses. So the way you would have underwritten that business would not be, wouldn't have been like, hey, I think coffee consumption is going to go up. Because in fact, if you look at coffee, the amount of coffee that's produced since Starbucks went public in 1992 till around today, it's only increased by about 1.9% a year. And that also includes population growth. So if you back out population growth, it's probably no more than 1% a year. And that's coffee production globally. So how do you account for Starbucks compounding at whatever 20% a year total return and over a 33-year period? It wasn't because people are consuming more coffee. No, it was because Howard Schultz created, a mega trend in and of himself. And he created a mega trend, which was he felt that, he went to Italy and said, I think that there's an enormous opportunity to create what he called a third space. So it's a third space between work and home where people can gather. It's not a bar, it's not a sit down restaurant, but it's a kind of a combination where people can have coffee, they can talk, and eventually they would buy food and different kinds of coffee drinks, etc. And you combine that with exceptional leadership, with exceptional execution, with a founder who could make really, really big, bold decisions, who could take risk, who could make bets and then change their mind, his mind in that case. And, I think they had 160 stores or something in the beginning. What allowed Starbucks to create such an enormous return for the people that owned that stock? Mind you, Starbucks was not a venture bet. It was not an early stage company by any means. By the time it went public, it was already a very established business, in terms of, it made plenty of money. Like I said, it had 100, I believe it had 160 plus stores. It was growing very rapidly. You could go do a lot of due diligence on the stores. You could figure it out. Like if somebody said, hey, spend the next year working on this company because I think there's something interesting here, you could figure it out. But no, it wouldn't
Right.
be, the mega trend wasn't coffee consumption. It was value migration away from the way Americans essentially in the beginning.
Yeah.
Then it went abroad, but Americans drank coffee at home. A lot of us grew up with our parents just having the drip coffee, the Folgers drip coffee or whatever. And then fast forward to today, and those aunts and uncles that used to only drink coffee at home or can't start their day without their Starbucks. And so, it's not necessarily about picking technology. It's, I think, going back and learning from those stories. And it doesn't mean that you need to hit all of them. I mean, you only need one or two of these in your lifetime. Like Buffett, the greatest investor ever
Right.
lived. He cites, like I said, like I think he said there's 12 companies in the whole history of Berkshire that really moved the needle. So if you can just get one of those 12, I mean, you're going to be better than most. But the key in Starbucks would have been, the ability to hold, because it's not a straight line up. It's not like the stock went from, where it was in 1992 over the next 33 years to where it is today. I mean, there were long periods of doubt, long periods of, very negative macro a very negative macro environment, interest rate changes. Oh, and by the way, the 10-year Treasury was at a 6% interest rate or 6% yield when Starbucks went public in 1992. So there was no earnings yield. This definitely wouldn't have been like a value stock. This would have been considered a very, very high priced, high flyer stock at the time.
Yeah.
But I think so. It's a tough thing, right? It's like you got to recognize the business. Then you have to be able to really, really focus an enormous amount of, I think, emotional time and to get to know the business and balance that with being honest with yourself. And has the thesis changed? Are they able to execute? And if something has changed, you have to be able to sell it. But if it hasn't changed, you can't let the stock price determine if you're going to sell. You have to be able to hold. And I've studied a lot of these multi-baggers, a lot of these really successful companies, and just trying to learn, what did people get wrong? Why couldn't people hold them? What were the bearish themes of these companies in history and in time, and try to apply that to today? And I'll tell you, it's not easy to identify the gorillas until everybody agrees that they're a gorilla. I mean, by the time the world agrees that Starbucks or Nike is the gorilla, the fruit's been largely picked. And now you're betting on, like in Nike's case, maybe a turnaround story. You're not going to get, you're not going to generate enormous returns from that. So I don't have, there's not an easy game. It's not an easy answer. Utpal was asked, like, essentially something along the lines of, when I heard him talk, why don't you just own a portfolio of gorillas and just call it a day? Well, if it was that simple, then we would just own all Google and 2005 and Amazon and 2001. We would just own all those. We would just cherry pick and go back in time and buy the best companies. You don't know if you have a gorilla necessarily, and you have to be willing to trim, and you have to be willing to say, trim through the portfolio and say, look, this one's just not going to work out. This one's not the gorilla that I thought it was, or things have changed, things have shifted. But every now and then, if you have that mindset and you have that filter, and these are the companies you're looking for, I think that you'll find one or two. And those one or two, if you're able to hold them, just make up for for everything. And again, it kind of dives into the power law you want to talk about. But I think that it makes up for everything. And that's, that's how investing works. That's how life works. So yeah, it's not an easy
Yeah.
game.
It's I think what's kind of we like to say is that you have to have an imagination to be an investor in terminal value companies, right? And usually I think, as Jeff touched on earlier, a lot of value investors want to be able to calculate a mean reversion because that's easier for math skilled oriented people. And if you're in a kind of an imagination investor, you're usually in venture capital or you're in kind of growth private equity. But here you do have to have these kind of long-term views. And you also have to realize one thing too, I think that is with gorillas, is that they can also do things like great companies surprise you in things that they can do that you didn't think they could do, and bad companies surprise you the other direction, right? Where they can fail in ways that you never thought. But like you mentioned Amazon, I mean, if you would have gone back to 2004 and said they're going to be one of the most dominant cloud providers, and then all the other things that come with Amazon, you wouldn't have thought that, right? That wouldn't have been something you underwrote in your thesis. But these gorillas give you that opportunity, right? That's right. There's kind of this call option that goes with them.
Okay, on that note, we will take a breather here. That was part 1 with Jeremy Deal. We'll be back in just a couple of days with part 2. We hope you enjoyed it. Thank you.